Welcome back to Money Talks, your guide to the Canadian securities. I'm your host, Rita, and I'm thrilled to have my brilliant friend and financial pro, Alexis Goldblum, with me today. Hey, Alexis, how's your week been?
Hey, Rita. My week's been great, thanks. Busy, but good. Always happy to chat finance with you.
Love to hear it. So, Alexis, we've covered a lot in previous episodes, from the market basics to equity shares, and even the fascinating world of derivatives last time. But this week, I've been diving into something foundational that sometimes gets less attention: fixed income securities, specifically how they're priced and traded. It feels like the bedrock of so many investments.
Absolutely. Bonds are the bedrock of so many portfolios, from individual investors to massive pension funds. Understanding how they work, how they're valued, and how they trade is absolutely key. They might not always have the flash of stocks, but they play a crucial role.
Couldn't agree more. So, for our listeners, when we talk about fixed income securities, the most common example being bonds, what we're really getting at is essentially a loan an investor makes to a borrower, usually a government or a corporation. In return, the borrower promises to pay regular interest payments. We call them coupons, and then pay back the original loan amount, the principal, at a set future date, the maturity.
That's the core concept. You're lending money for a set period and getting interest for it.
Right. Now, the concept of pricing these, figuring out what a bond is worth today, really comes down to the idea of present value. Let's make it simple. If I offered you $100 today, or $100 a year from now, which would you take?
Today, every time. Money today is always worth more than the same amount of money tomorrow. That's the time value of money.
Exactly. That's the present value concept. You need to be compensated for waiting, for the risk, for the loss of potential earnings on that money over time. So a bond's fair price today isn't just its face value. It's essentially the sum of the present value of all those future coupon payments you expect to receive, plus the present value of the lump sum principal you get back at maturity. We use a discount rate to figure out those present values.
And that discount rate is super important. It's basically the market's required rate of return for that specific bond, based on things like prevailing interest rates and the borrower's creditworthiness, their risk of defaulting.
So the bond price moves up or down so that its potential return, its yield, aligns with what the market demands?
Precisely. Which brings us perfectly to the concept of yield. Rita, when people talk about a bond's yield, what are they usually getting at? It can be a bit tricky.
It sure can. The simplest measure is current yield. That just tells you the annual cash income you get from the bond relative to its current market price. So if a bond pays $9 a year in coupons on a face value of $100, but you can buy it today for $96.77, its current yield is about 9.3%. It's a quick snapshot of the income stream right now.
Right, but as you mentioned, the most popular and comprehensive measure, the one that truly reflects the bond's total expected return if you hold it, is yield to maturity, or YTM.
Ah, YTM. That one sounds more complex. How is it different, and why is it the preferred measure?
It's more sophisticated because it factors in everything. YTM is the total return you can expect to earn if you buy a bond today, get all the coupon payments, and hold it all the way until it matures and you get your principal back. It accounts for the coupon payments plus any capital gain if you bought the bond below face value at a discount and it matures at face value, or minus any capital loss if you bought it above face value at a premium.
So if I buy a bond trading at a discount, its YTM will be higher than its coupon rate because I also get that gain at maturity?
Exactly. And the key assumption with YTM is that you can reinvest all those coupon payments you receive over the bond's life at that same YTM rate.
That reinvestment assumption brings up something called reinvestment risk, right?
It does. If interest rates fall after you buy your bond, you might not be able to reinvest those future coupon payments at the same high rate that was calculated in your original YTM. This means your actual total return could end up being lower than that initial YTM suggested. It's why, for example, zero coupon bonds, which don't pay regular interest but are bought at a deep discount and mature at face value, have no reinvestment risk because there are no coupons to reinvest.
That makes a lot of sense. Now, let's pivot slightly and talk about interest rates more broadly, because they are absolutely crucial to how bonds are priced and how their prices move. We often hear about the yield curve. What exactly is that, and what can it tell us about the market or even the economy?
The yield curve is a fascinating tool. Think of it as a graph that shows you the yields of bonds with similar credit quality, say, Government of Canada bonds, which are considered very safe, plotted against their different maturities from just a few months out to 30 years or more. It's a snapshot on a specific day of the term structure of interest rates.
Okay, so it shows the relationship between yield and how long until the bond matures?
Exactly. The most common shape is an upward sloping or normal yield curve. This is where longer-term bonds have higher yields than shorter-term ones. This typically happens because investors demand a higher return for tying up their money for a longer time. And often, it reflects the market's expectation that interest rates might rise in the future.
So if the curve is upward sloping, it's a pretty good sign that the market expects rates to go up down the road.
Generally, yes. That expectation is a big factor, as is the liquidity preference idea. People prefer shorter, more liquid bonds, so they ask for a premium to hold longer ones. Sometimes you'll see a flat curve or even an inverted curve where short-term rates are higher than long-term rates, which can sometimes signal market stress or even a potential recession as the market expects rates to fall sharply in the future. It's like the market's forecast mapped out.
It really is like reading the tea leaves. Speaking of how interest rates change, let's talk about the most fundamental rule of bond pricing, which you mentioned earlier. How do bond prices react when interest rates in the market go up or down?
This is the crucial relationship to remember. Bond prices and interest rates move in opposite directions, always.
Always. Okay. So if general interest rates go up, the price of a bond I already own goes down. And if rates fall, my bond price goes up.
Precisely. Here's the simple way to picture it. Imagine you own a bond that pays a fixed 3% interest rate every year because that was the market rate when it was issued. Now, suppose general interest rates in the market go up and new bonds being issued are paying 4%. Your old 3% bond is suddenly less attractive because investors can get a higher return elsewhere. For someone to be willing to buy your old 3% bond, its price has to fall below its face value. That way, the lower price they pay, combined with the 3% coupon and getting face value back at maturity, gives them an overall yield competitive with the new 4% bonds. And the exact opposite happens when rates fall. If new bonds pay 2%, your 3% bond looks fantastic. Its price will go up as demand increases until its yield is also competitive with the new lower market rates.
That analogy makes it crystal clear. It's like supply and demand based on the attractiveness of the interest payment compared to what's currently available.
Exactly.
And does how long until the bond matures or its coupon rate affect how much its price moves when interest rates change?
Absolutely. This is where it gets a bit nuanced. Generally, the longer the maturity of a bond, the more sensitive or volatile its price will be to changes in interest rates. A tiny change in rate has a much bigger impact over 30 years than over 3 years. Also, lower coupon bonds are generally more sensitive than higher coupon bonds with the same maturity. This is because a larger portion of their total return from a low coupon bond comes from getting the principal back at maturity, which is way out in the future. Changes in the discount rate affect that future payment more significantly over time compared to a high coupon bond where you get more of your return sooner through larger regular payments.
Okay, so longer maturity and lower coupon mean more interest rate risk or price volatility. That makes intuitive sense.
And this leads us to a really important concept for managing bond portfolios: duration.
Yes, duration is fantastic. It's a single number that tells you how sensitive a bond's price is to a 1% change in interest rates. The higher the duration number, the more its price will move for a given change in rates. It's an incredibly useful measure for investors and portfolio managers to understand and manage the interest rate risk in their bond holdings, allowing them to compare bonds even if they have different maturities and coupons.
That sounds incredibly useful. It's like a bond's personal interest rate volatility score. Now, let's quickly touch on how these bonds actually change hands here in Canada. The bond market can feel a bit less visible than the stock market with its trading screens. Who are the main players?
It's often less visible because it's largely an over-the-counter market, meaning trades happen directly between parties, not on a central exchange like the Toronto Stock Exchange. You have the sell side, which is the big investment dealers like the major banks. They help issue new bonds and trade bonds for their firm or clients. Then there's the buy side. These are the large institutional investors, mutual funds, pension funds, insurance companies, wealth managers. They are buying massive amounts of bonds on behalf of their clients.
And what about interdealer brokers? I've heard that term.
Interdealer brokers are key intermediaries, especially in the institutional market. They facilitate trades between the big buy-side and sell-side firms, often providing anonymity to prevent market participants from seeing who's making large trading moves and potentially impacting prices. A significant amount of Canadian bond trading between institutions flows through them. For individual investors, you typically buy bonds through your investment advisor, and the transaction is done electronically or over the phone, handled by their firm's trading desk. And most bonds today aren't physical certificates. They're in a book-based format, just an electronic record kept by a central depository, like CDS Clearing and Depository Services, Inc., here in Canada.
So much simpler than carrying around paper. And finally, a practical point for our listeners: accrued interest. What is that, and why does it matter when you buy a bond?
It's pretty straightforward and fair. Most bonds pay interest twice a year. But if you buy a bond between those interest payment dates, the seller has held the bond for a portion of the current interest period and has earned some of that next coupon payment, even though they haven't received it yet. So, when you buy the bond, you pay the seller the accrued interest, the portion of the next coupon payment that they've earned from the last payment date up to when your purchase settles.
Okay, so I pay them what they've earned.
Exactly. And then on the next official coupon payment date, you, as the new owner, receive the full coupon payment. This effectively reimburses you for the accrued interest you paid the seller, plus the interest the bond earned while you owned it during that period. It just ensures that interest income is correctly allocated between the buyer and seller based on who owned the bond for how long during the coupon period.
That makes perfect sense. No free rides on the interest. And to wrap up, how do bond indexes like the FTSE Canada Universe Bond Index fit into all this?
Bond indexes are important benchmarks. First, they measure the overall bond market or specific segments. The FTSE Canada Universe Bond Index is widely used here to track the broad Canadian investment-grade bond market, a mix of federal, provincial, government, and corporate bonds. Second, they're a benchmark for performance. Portfolio managers are often measured against these. And third, they're used to create bond index funds, or ETFs, allowing investors to get diversified exposure to the bond market by tracking an index.
Fascinating. From understanding present value and yield to navigating interest rate sensitivity with duration, and even the nitty-gritty of trading and accrued interest, we've covered so much ground on fixed income securities. It really shows how bonds, while perhaps less flashy than stocks, are a sophisticated yet crucial component of the financial world and the Canadian securities market. Thank you, Alexis, for breaking this down for us in such an accessible way.
My pleasure, Rita. It's a vital area for any investor to understand, whether directly holding bonds or through funds.
And thank you, our listeners, for tuning in to Money Talks, your guide to the Canadian securities. We hope this episode helped demystify how bonds are priced and traded. If you found this conversation helpful or learned something new, please show your support. Take a moment to like this episode, subscribe to the podcast feed wherever you listen, and share it with anyone you think would benefit. And we'd absolutely love to hear your thoughts or any questions you have about bonds. Leave us a comment. Your engagement helps us bring you more content like this. We'll be back next time with another deep dive into the world of finance. Until then, keep those financial minds curious.